Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody. For those that don't know, I am Chris Seveney with Seveney Investments. And today's episode, I want to talk about navigating the world of non-performing notes and talk about what we do on a daily basis with our portfolio so people understand kind of what goes on. What's a day in a life of a note investor who's, running a fund that's buying and selling and managing these mortgage loans that we're acquiring. Before we get into that, I do want to talk a little bit about, just for people who haven't listened in the past, really define the mortgage note, what it is, why do we buy non-performing, and a little bit more about our Regulation A+ offering, where investors can invest with as little as $5,000, and that money goes into the company, which the company then takes those funds to buy a portfolio or single assets, and we mix it up with performing and non-performing loans. And we mix it up because we want that diversification of the portfolio for us, which we believe to attempt to try and mitigate some of that risk. Where if you have all non-performing loans, it's like having all high risk something that, your variations could fluctuate, where you always want that mix. So I wanted to start out with that and really focus on, first, dive into non-performing loans. And what is a non-performing loan? Which somebody is not paying on the mortgage. And all the assets we buy are backed by real estate. We don't get into car debt, credit card debt, student loan debt. We stay away from all of that information. We just focus on mortgage loans. So it's something that's secured by a property. So if the borrower ends up not performing, we can go ahead and start the process to potentially exit through the property versus through the borrower, which is our preferred method. If you want to learn more about our different exit strategies, feel free to go watch some of our prior webinars. We talk a lot about those exit strategies that we have. So on a daily basis, managing a portfolio of loans is not easy. And today, I'm not even going to talk about our investor relations side of things. That team works in regards to making sure our 700 plus investors questions are answered. They're getting their distributions on time. We're answering questions for people who are interested in potentially investing with us. That's a whole separate segment of the business. Today, I really want to focus just on that asset management side. And there's really three key components of the asset management. There's one, our acquisitions, which is acquiring assets that I'll talk about for a few minutes. Second is the actual asset management of after you acquire the loan. And third is the exit strategies and disposition of the loans. So let's talk about the acquisition side of things, which every quarter for this year, first 3 quarters, to give an idea, we have seen approximately $5 billion with a B dollars in loans. So think about that for a second. So we're through 3 quarters of the year. So we've seen probably about $15 billion in loans. And on average, we're buying, $1-2 million a month in loans, plus or minus. So think about that in the sense of 1 million to 5 billion. Us, we see plenty of opportunity. The challenge is, how do you go about selecting the right deals? And that is something that, as somebody who also invests, and as somebody who, if you're looking to invest, question you should ask: how do you source your deal? Not only how you source the deals, but how do you choose the right deal? It's very important as a fund to make sure, A, it's a balanced portfolio, but we're choosing the right deals. And for us, we do a process which is called cherry picking. So we will not just look at a whole tape and then say, okay, we are going to bid X amount of dollars without looking at every single asset. That is one of the differentiators we hold against some of our larger competition. They don't have the manpower, the time, or the staff to go through every single asset. For example, there's a loan pool that has over 2,000 assets that is bidding next week. And we can't bid 2,000 assets. It's $750 million. We went through and sourced select areas that we want to, and then we target and specified specific assets that we want to target as part of that. And for us, it's being extremely focused is what we want to look at. We also see other pools of assets that we don't try and force the issue on these loans. And okay, Chris, what does that mean, force the issue? To me, I read that as taking additional risk. For example, we saw some loans, we made some offers, and they came back and countered. And if the property were to go down the foreclosure path, it would be a really good deal. But if the borrower, who's only 4 months behind, turned around and got caught up and made those payments, it would be a really bad deal. And you might ask, well, Chris, how is it better, some instances, to foreclose and take the property back? And here's the reason why. The loan was modified to a 2% interest rate, or it was written at a 3% interest rate. In certain states, you can foreclose in 90, 120 days. So if you're buying it at a 20% discount, 30% discount, it makes sense. But let's take that loan as if it was only 4 months behind and they turned around and made those 4 months payments, or filed bankruptcy and you're only buying it at a 70 cents on the dollar. It doesn't make sense because your return on that asset, because it's got, a little bit of a discount, but you're buying a loan at 2 or 3% essentially, is going to crush your long-term plans because the borrower is never going to refinance. They may sell, but you're also not going to be able to sell that loan. Think about what happened with Silicon Valley Bank. They had all these bonds and everything at 2 and 3%. People wanted to get all their money out. They had to go sell these bonds. Who wants to buy a bond at 2.5% when the bond market's at 4.5%? They had to significantly discount it, which hurts their numbers. So a typical acquisition, after we go through and cherry pick, is as a team, we will go through an initial round of selecting the ones we want to target. Then we'll put numbers to them. And it's all part of due diligence where we look at, as much about the person, the property, predicament. Again, we've got episodes on how we do all of that. I want to stay high level today, which people who know me are probably laughing. I never stay high level. And go through the assets. We put numbers to them. And then as a team, we have an acquisitions investment committee team that we meet once a week. And we review the numbers and go through and kind of ask questions with each other and kind of put a final score to that asset and determine, okay, we're going to bid this or we're not going to bid it. And that is the process that we have as part of that first phase. If an asset gets a bid accepted, then we go through a whole nother process of what's called a go, no go, which is a fancy Excel spreadsheet where we put all the information down. And where this comes in handy for me as CEO of the company, now my team members put this together. And then when we have our second round of investment committee meetings, I can just look at the spreadsheet. I don't have to go through all the notes, go through everything. We've already had the title review by attorneys. We got the BPOs. Now we've got everything we need. And it's just kind of the checklist of, okay, here's everything we know. We score that loan based on a 0 to 100. And does it meet a specific score or profile based on our targeted return? We say yes or no, and we make a final decision. So a lot of interaction within the team, a lot of eyes looking at the asset, a lot of questions that get answered. Well, what happens if this or that? So, the context is very communicative and working together as a team to go through, because there's sometimes somebody else picks something up, and we keep, of course, great records of everything we do in every situation and scenario. So I think we have this process down pretty well. So acquisitions. So we're always constantly having acquisitions going on, and we're constantly, we meet every week to go through all of the acquisitions that we're having. So now let's talk and shift over to the asset management side. We've acquired the asset. Now, how do you manage these assets? And Larissa, who is a team member, handles all the day-to-day. What does that mean? What's a day in the life of Larissa? And I used to do this and manage a large portfolio while working W-2. So I know this is not an easy assignment or easy task because Larissa is constantly dealing with servicers, or the people who collect the money, answering questions, what borrowers who are behind want to make a partial payment. Do we accept it? Do we not? Loans that are in foreclosure, bankruptcy, or some form of loss mitigation. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. Again, having the communication of, okay, let's get a forbearance, draft a forbearance, make sure it's reviewed, foreclosure, chasing attorneys, making sure they're staying on top of the paperwork. Because while investing in notes is slow, like watching the grass grow, it's like 30-day increments of things typically happening. People pay their mortgage, or like a demand letter is 30 days. You want to make sure you stay on top of these people, whether it's a servicer, attorney, or whoever it is, because 30 days will pass, 40 days will pass, and you think they're doing something and did not set a reminder. They're just wondering, oh, we haven't heard from the lender, so all must be good. It's always important as asset management, you are the manager and you are in control. Perfect example I'll share was recently there was a post I saw online where somebody asked a question of, okay, what is the servicer doing in areas that were struck by the hurricane in North Carolina? We're recording this in October 2024. And I kind of chimed in. I'm like, what do you expect them to do? You are the lead. You're the manager. You're paying them a specific amount per month to call the borrower and to collect the payment. That's what they do. Now, if there's no power or anything, what do you want them to do? Now, if you want to pay to have somebody stop by the property, they'll arrange that for you, but they're not going to, they do what you're told. So think of it being kind of like, AI a little bit of, you ask AI a question, it's going to respond, but it's not going to magically just tell you, out of the blue, like, hey, I think you should do this today, without you prompting it. Again, you have to prompt the servicer to perform a specific task if you want it done. Same thing with the attorneys. Same thing with title companies. So as part of this asset management, it's not you just sit on your hands and wait. You got to be very, very proactive working with all the vendors. And there's many more vendors that your servicer, your attorney. If you take properties back, there's REO companies, which we'll talk about dispositions. There's title companies because you might be ordering title reports. There's BPOs where you're ordering price opinions on properties. There's door knockers where people who go knock on the door. There's the bankruptcy trustees. There's your bankruptcy attorneys. So there's a lot of individual players. And some loans can really suck up a lot more of your time in regards to a lot of back and forth to attorneys. There's also the paperwork side of making sure all your paperwork is in order. So there's a collateral custodian recording all the docs. So there is a lot going on. Think of this person as kind of like the project manager on a construction site. If you've ever been a part of any renovation, they're the ones managing all the subcontractors, which is what this asset manager does on a loan while it's non-performing. But what this person also plays that role of is thinking of them as that project manager. They're also playing the role of assisting on the acquisition side. So they're helping you buy the assets as well. And lastly, there's that disposition side, which I think a lot of fund managers, from what I've seen, this is the area where they don't have put the most attention to. And I find this to be extremely important to understand as a company that manages a fund investing and performing and non-performing loans, that there's a specific churn of assets coming in and assets coming out the door that you need to do. And if you want to maximize your revenues, maximize your profits, you need to know, A, when it's time to give up on a loan, but B, also know when it's time to sell a loan. So let's take loans that are non-performing, that you're stuck in litigation. We had one in New York that we sold because we knew it was just going to continue to get stuck. We sold it. We made money on it. Did we make what we wanted to? No. The longer we held it, it was just, I think, going to burn a bigger hole in our pocket. The other is after you get a borrower reperforming and they start paying again, there's 6 to 12 months, payments. You want to churn that loan. You want to sell it to an investor as a reperforming loan. Hopefully you're confident that they will keep paying that loan, and then use that money to then reinvest, maximize, your profits on that one to get another one and rinse and repeat. So I wanted to just share that because I think that's something that people always focus on, the acquisitions, because that's the sexiest part of note investing is, I'm buying this loan. I got this loan. That's the easy part, is buying. Managing and getting rid of it, that's the hard part. That's really honestly where you make your money. I know everyone says you make your money on the buy. In notes, the price you're going to pay me versus somebody else is probably going to be pretty close unless you screw up that number. Kind of like a preset, like you're going to go to a store and buy a gallon of milk. You can go to 3 grocery stores, but the gallon of milk is the cost. What you do with that gallon of milk to maximize its use is basically where you add the value. And that's where I think asset management and disposition and note investing comes into play. That's where I think we have a great advantage based off of our team and our people. So I wanted to mention that because, again, people always focus too much on that acquisition. What do you have to do in the disposition side of things? There's a lot, actually, sometimes considered painful, especially if you have an REO. For us, we use a third-party company that will help us liquidate it. It's not often we do any type of renovation on a property, but we do on occasion. And that person, again, now acts as a project manager managing that disposition. They're making sure that, as an REO, that they have an agent line, the grass is still getting cut and the property is still within its phases. If there's a price reduction, they're working on that. If you're selling a loan, they are responsible for A, collecting the bids, reviewing the bids, analyzing the bids, providing all the due diligence documents to the buyer, putting together the contract, putting all this stuff together, and then making sure after it's sold, A, the money comes in the door, the servicing transfer to them goes well as getting all the documents that the buyer is going to need from your company in order to record that loan. And then foreclosure, which is probably the most stressful, which is working with the attorneys, making sure they have all the proper documents, making sure it's, going to sale, there's no hiccups, making sure we've got the right numbers we want to bid on. They put together, again, a nice spreadsheet of a sheet understanding what do we want to bid on this asset. If it's $100,000 payoff, do you bid 100 or do you bid 80? And people say, well, why would you bid 80? And the answer is, well, if I take it back at 100, then pay a transfer tax. I'll have to get an agent to list it. I'm now going to pay property taxes. I'm now going to pay insurance. I'm going to spend $10,000 easily at the blink of an eye. And it's probably not going to sell for 100. Whereas if I sell for 80, I don't have to worry about any of that. 80 may end up netting you more than 100 does. And this is that game, that you got to play and balance out of try to maximize your value without overinflating your number to cause more work for you and also provide you less income. I know I rambled off a lot today, kind of in the day in the life, but these are all the things that are constantly going through our heads every single day. And for example, right before this call, I look and get an email that we're negotiating with a seller and there's some title issues on the loans. And our attorneys and their attorneys trying to go back to get this resolved. And it's kind of like that ping pong back and forth. And, we're trying to, let's just get on a phone call. Let's go back to the 20th century where people actually use these things called phones, not electronic devices that just send messages, but something you can actually speak with. We probably would have had this resolved and we were probably closed on this asset last week. Another thing we're looking at is we have 2 loans right now that we have under agreement in Florida. And today is, I'm recording this on a Monday, but there's a hurricane hitting Florida on Wednesday. Not sure which area it's going to hit. But now it's additional due diligence, our team is doing to, make sure that's all taken care of. But the best way to explain a day in a life as I wrap this episode up is Every note investor goes into the day not really sure what that day is going to be. You can have a list of 5 or 10 tasks you want to have, but one little thing from an attorney, an email, or something can, just like a snap of a finger, completely throw you in a tailspin and have to drop what you're doing to tackle this other issue. That's why I love this business. That's what my real estate career has been. When I was in the real estate side for 25 plus years, that's what it was. And you go to work hoping you get certain things done, or you knew you had certain meetings, but in between those meetings, you had no idea. So hope to shed some light on a day in the life of a mortgage note investor when you're working and operating on a fund. As always, please leave us a review on your favorite listening station, iTunes, Spotify, or Amazon. And if you want more information about us, our offerings, make sure to visit us at seveneyinvestments.com. Thank you all. Take care. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.